When it comes to investing in companies, venture capital and private equity are two of the most well-known funding models. While both involve investing in businesses with the goal of generating high returns, they differ significantly in terms of investment stage, risk appetite, ownership structure, and exit strategies. So, what is private equity? Private equity firms typically invest in mature, established companies that already have steady revenue and profitability. Unlike VC firms, which focus on startups, private equity firms look for businesses that are either undervalued, underperforming, or ripe for restructuring. Their goal is to increase efficiency, optimize operations, and drive profitability before exiting with a high return. VC firms, on the other hand, focus on early-stage, high-growth startups that are still in the process of scaling. These companies often have high potential but little to no profitability, meaning they need capital to grow, expand their market presence, and develop their technology or product. Because VC-backed startups are often risky and unproven, venture capitalists take minority stakes, investing in exchange for equity ownership while allowing founders to retain control. The typical VC investment strategy is high risk, high reward. A VC firm builds a portfolio of startups, knowing that many will fail, but the few that succeed, often called unicorns, can generate massive returns. The goal is to scale the company quickly and exit within 5 to 10 years, usually through an IPO or acquisition. VCs also take an active role in guiding their portfolio companies, often providing mentorship, board representation, and connections to potential customers, talent, and future investors. A key difference is that private equity firms almost always acquire a controlling stake, often 100% ownership, in the companies they invest in. This means they take full control, replace management if necessary, and implement aggressive strategies to improve financial performance. Unlike VCs who look for explosive growth, private equity firms prioritize cost-cutting, operational improvements, and maximizing cash flow. Another major contrast is the investment structure. While VCs invest in multiple startups expecting a few big winners, private equity firms bet on fewer companies, but with much larger investments, often hundreds of millions or even billions of dollars. Instead of making risky bets on unproven startups, private equity firms target businesses with stable cash flow that can be optimized and later sold at a profit. Exit strategies also differ. VCs aim for IPOs or acquisitions by larger tech firms, whereas private equity firms typically exit through strategic sales, secondary buyouts, or taking the company public after restructuring. In many cases, PE firms use leverage, debt financing, to acquire companies, a practice known as leveraged buyouts, also said LBOs, allowing them to maximize returns by using debt to finance acquisitions. So, which is better? Venture capital or private equity? The answer depends on the type of company and the stage it's in. VC is best for startups that need capital to grow and scale quickly, while private equity is ideal for established businesses that need operational improvements and financial restructuring. For founders, choosing between VC and private equity depends on the stage of their company, their long-term vision, and how much control they're willing to give up. If they're building an innovative, high-growth startup, VC is the way to go. If they run an established business looking for an exit or major transformation, private equity may be the better fit. Ultimately, both VC and private equity play a crucial role in shaping businesses, driving innovation, and fueling economic growth, but they operate in very different ways, with different objectives and risk profiles. Venture capital and private equity differ in their approach, risk tolerance, and investment strategies. Private equity targets established businesses, acquiring majority control to optimize operations and drive profitability. In contrast, VC backs early-stage startups with high growth potential but uncertain profitability, taking minority stakes and focusing on rapid scaling. While private equity firms rely on strategic sales, buyouts, or public offerings post-restructuring, VC exits through IPOs or acquisitions. Finally, both funding models play critical roles, but the right choice depends on a company's stage, growth needs, and willingness to cede control.